Picture yourself staring at a document packed with numbers, charts, and words that seem to dance on the page, and you're wondering, where do I even start? Financial reports can feel daunting, but they're like a treasure map for your investments, revealing clues about a company's health. Today, I'm going to walk you through, step by step, how to read these reports like a pro, without complex jargon, just clear ideas. Ready to turn those intimidating pages into smart decisions? Let's dive in. First, what's a financial report? It's like an X-ray of a company, a snapshot of its performance, its money, and its plans. Think of a company as a person. It earns money, spends, and sometimes borrows. These reports show you all of that, and understanding them can make the difference between a winning investment and one that flops. Let's start with the basics. Every report has three main parts. There's the balance sheet, the income statement, and the cash flow statement. Each tells a piece of the story, like chapters in a book. Together, they give you a full picture to decide if a company is worth your money. The balance sheet is like a photo taken at a specific moment. It shows what the company owns, what it owes, and what's left for the owners. Imagine checking a friend's wallet, how much cash they have, how much they owe the bank, and what's left after that. That's exactly what the balance sheet does for a company. On the balance sheet, start with the assets. These are the things the company owns: cash, buildings, machines, or even patents. Current assets, like money in the bank, can be used quickly. Long-term assets, like a factory, take longer to turn into cash. Next, look at the liabilities. These are the debts, like bank loans or bills to pay. Current liabilities are due soon, usually within a year. Long-term liabilities, like a mortgage, stretch over years. Now, subtract the liabilities from the assets, and you get the equity. This is what belongs to the shareholders, like you, if you invest. High equity is usually a good sign. The company is worth more than its debts. But be careful. Always compare it to similar companies for context. Let's take an example. Imagine a coffee company, Sun Cafe. Its balance sheet shows $500,000 in assets, with $200,000 in cash and $300,000 in equipment. It has $200,000 in debts, so its equity is $300,000. That seems solid, but if its competitors have more cash, it could be a red flag. Moving on to the income statement, the second key piece. It shows how much the company earns and spends over a period, like a quarter or a year. It's like checking a person's salary and expenses. Are they earning more than they spend? That's the big question. On the income statement, start with the revenue. This is the money the company makes from selling its products or services. For Sun Cafe, it's what they earn selling cappuccinos and pastries. Revenue growing year after year suggests the company is attracting customers. Then, subtract the costs, like rent, salaries, or raw materials. What's left is the gross profit. If Sun Cafe sells $100,000 in coffee but spends $60,000 on beans and staff, its gross profit is $40,000. The higher this number, the better, as it shows efficiency. But there's more. After gross profit, subtract other expenses, like advertising or taxes. You get the net income, the real bottom line. If Sun Cafe ends with a net income of $10,000, that's what's left after paying everything. One key point: net income should be consistent. A company that earns a lot one year but loses the next is risky. Check the trends over several years. If Sun Cafe's profits are steadily growing, that's a good sign for investing. Now, the cash flow statement, the third pillar. It shows how money actually moves in and out of the company. Profits are great, but if cash isn't flowing, the company can hit trouble. It's like having a big salary but no cash to pay the bills. This statement has three parts: operating, investing, and financing cash flows. Operating cash flows show money from the main business, like selling coffee. If Sun Cafe makes $50,000 from selling lattes, that's a positive operating flow. It signals a healthy business. Investing cash flows involve buying or selling assets, like a new coffee machine. If Sun Cafe spends $20,000 on equipment, it's a negative flow, but it could be strategic for growth. Check if these expenses make sense. Spending too much here can drain the coffers. Financing cash flows cover money from debts or shareholders. If Sun Cafe borrows $30,000 or pays dividends, it shows up here. Too many loans can be risky, but paying dividends shows the company shares profits. Balance these signals to make a judgment. So, how do you use all this to invest? Look at financial ratios, simple calculations that sum up the company's health. For example, the debt-to-equity ratio. Divide total debts by equity. If Sun Cafe has $200,000 in debts and $300,000 in equity, its ratio is 0.67, which is reasonable. Another useful ratio is the return on equity. Divide net income by equity. If Sun Cafe has $10,000 in net income and $300,000 in equity, the return is about 3.3%. Compare it to other companies to see if it's competitive. But numbers aren't everything. Read the report's notes, usually at the end. They explain details like lawsuits or strategy changes. If Sun Cafe mentions an expensive legal battle, it could hurt future profits. Take a moment to reflect. If you were investing in Sun Cafe, what would you look for? A company with low debt, steady profits, and a clear growth plan. These reports give you the answers, but they take patience to decode. If this still feels overwhelming, practice. Pick a company you like, find its financial report online, and start exploring. Note the numbers that surprise you. Compare them to competitors. The more you read, the clearer it gets, like learning a new language. Before we wrap up, I'd love for you to think about one thing. Which company would you analyze first? Share your thoughts in the comments, and if this journey through financial reports sparked some clarity, give it a thumbs up and subscribe to catch more tips. It helps us keep sharing these insights with you. In short, reading a financial report is like reading a story. The balance sheet shows the current state, the income statement reveals performance, and the cash flow statement tracks how money moves. With practice, these documents become your allies for smart investing. Take your time, ask the right questions, and soon the numbers will start speaking to you.